To my right, a man that needs no introduction, Donald Kaberuka, President of the African Development Bank. Please join me with a round of applause.
Thank you.
To my left, the other co-chair, Maktar Diop, the Vice President for Africa at the World Bank. To my far right, we have Mahesh Kotecha, who is the founder and managing director of Structured Credit International Corporation. And to his left, you have Helen Tannoy, who is the founder and managing director of Aldridge International. And to our far left, last but by no means least, the new class of investor on the block that we're going to be hearing a lot from today, Uche Orji, the CEO of the Nigeria Sovereign Investment Authority.
Right.
So we all understand that this is a very big issue and a big topic, and I'm sure just on the headline we can have a very long conversation about that. But I think in the order of creating some kind of structure and so that we can have some takeaways and facilitate some very focused interventions from the panel and also you from the floor, we're going to break it down into sort of 4 sub-themes. The first is really going to be looking at the nature of the perceived versus actual risk and how that's priced and how it can be better and more intuitively and cleverly mitigated. The second area is looking at compartmentalization. In other words, just really making sure that the right risks are aligned with the right investors, so we're asking the right people for the wrong things. Then also we're going to be looking at insurance instruments and other innovations in the market capable of reducing risk. And then finally, many of you in this room either work with or are international financial institutions and DFIs. We're going to be trying to have a better conversation about going forward, how can we collaborate more to reduce the perceived riskiness of investing in Africa's infrastructure. Well, we're going to start with both of our co-chairs who will give some keynote opening remarks. So may I first turn to you now, Donald, for your opening keynote remarks. Thank you.
Thank you. Thanks so much, Hubert. Can I begin by thanking you all, first of all, for coming to the African Development Bank Annual General Meeting. I know there's a lot of competing demand on your time, but I think that you thought this would be a useful place to come to. Those of you who are not governors of the bank, I want to thank you for that. We like to think of the Annual General Meeting as a place where we transact statutory matters for the bank, but also as a convening point for Africans and their partners to discuss issues which are germane to the development in Africa, such as the one we're discussing now. So thank you all for coming. And of course, thank you also for coming to Rwanda. Now, I would like to divide my answer into parts, Hubert. There is the question of Africa risk and then infrastructure risk anywhere. Because I think also even rich countries, they've been having some challenges getting private money into some infrastructure projects. So on the first part, you could agree with me that for far too long, African assets have been undervalued because Africa risk has been exaggerated. Now, that seems to be changing, and I think the financial crisis has accelerated the change. People are looking at Africa as a place where you have risk like you have in Latin America, in Asia. All you have to do is identify it, price it, mitigate for it. And we want to welcome that change. Now, specifically to infrastructure, if one of you was now to wind back to 1980s, early 1990s, when people thought that telecommunication was something only done by governments, people were saying all kinds of things about telecommunication. And then there was deregulation and strengthening of the regulatory environment. And then there have been this explosion in telecommunication and IT-related infrastructure. Of course, there are still huge gaps, even there. But I think we have come a long way in that particular area. Now, here we are talking about problems, Hubert, but I think we can also talk about things which are beginning to work very well. And we've got some examples here of best practices, things which have worked, which are working, and maybe those could inspire us in terms of answering your questions. So I'm here with Tas, somebody. Tas, if you could stand up, please. Who replaced me on this panel at some point. And this is the reason Tas will replace me. We have looked at the infrastructure financing in Africa at the bank since independence. Now, what have we found? We've been funding infrastructure mainly with public money, limited, and then foreign aid, now also limited. Of late, increasingly China. But I think we're coming to a plateau where public resources are not going to increase dramatically in relation to the gap which we have. Now, here's the problem, though. Although the gap is supposed to be big, $50 billion, in relation to what is available on the capital markets, that is not a drop in the ocean, but it's not very significant. So there is a mismatch between the needs and the supply. So what we have thought to do in the African Development Bank is to create a new vehicle for funding African infrastructure, which Tas will explain. We call it Africa 50. The word 50 is symbolic, is because we are 50 years after independence. And here we are discussing the next 50 years in African development. So Tas will walk you through the structure of this vehicle, which has basically two arms. Arm number one, project preparation, to bring those projects to a level where they're attractive to private funding. And the African Development Bank is putting in up to $100 million in that particular facility. My board of directors has just approved the first installment of $20 million to get those projects ready. We have also decided to take equity in that vehicle as a corner investor. I'm hoping that in due course, we'll be able to put in up to $500 million as equity. But for now, we'll be putting about $100 million. Now, this vehicle is open to African investors. We want to be an African-driven vehicle, an African-owned vehicle. But it's also open to foreign investors because the projects we shall be doing are those which are commercially viable. We, as a corner investor, will be looking for transformative projects which are priority for Africa. But they must be commercially viable, make sense, give a good return. The financial models, which Tas will explain to you, will show you that this thing can actually be done. So I do think, Herbert, maybe instead of focusing on what is not working, why don't you focus on how can we make it work, as we have done in this particular vehicle? And I'm happy that Tas with research can explain to you later in details.
Fantastic. Well, thank you, Donald. That's good inspiration for us all. And I think some of us are aware about the Africa 50's agenda and focus, but not everyone. So we're going to look forward to hearing a bit more from Tas on the project. But I can assure you we've got some very innovative thoughts and very concrete proposals around success stories and ideas that we can actually learn from and then maybe create better successes off of situations that haven't necessarily done much besides give us a learning experience. But to move on, I'd like to now call on our second co-chair, Makta Diop, to give us his opening perspectives and keynote remarks.
Good afternoon, Herbert. Thank you so much for accepting to facilitate this panel. And I would like to thank President Kaberuka for his hospitality. And this panel actually came out from discussions that President Kaberuka and I had many times about how to accelerate investment in Africa. And we were, each of on our side, President Kaberuka launched his great initiative, Africa 50, which is really, for me, making a huge difference. On our side, as a bank, we've been accelerating our portfolio on infrastructure, pushing our private sector branch, IFC and MIGA, to do more infrastructure in Africa. MIGA, for instance, now half of his portfolio is in Africa. But we are both saying that it's not enough. What can we do more to really accelerate that process? And we thought we both have this idea of getting into the black box. This box, which is called risk, that was very, very described by President Kaberuka, and where the pricing of assets in Africa has nothing to do with the fundamentals. If you look at actually fundamentals is there is very few economies in the world. We have a debt rate ratio below 50%. This is the situation in Africa. So if you look at fundamentals like inflation, like debt ratio, like fiscal deficit, Africa is basically performing better than a lot of African countries in the world. And when it comes to investment, you ask your question, why it's not following? It's not following only from FDIs, but even the little savings that we have on our continent, pension fund, institutional investors don't feel confident to invest in assets in Africa. So there is not only a perception of risk which is high by foreign direct investors, but by local institutions. And there is a good reason for that. Let's go back 20 years ago, 25 years ago, there were not these institutional strengths that you have from in our economies which allow pension fund holders, insurance, to really protect their assets and invest it in an economic way. They were a little bit forced by government to put it wherever they were told. And the new generation and the reforms were put in our countries, and people understood that we need to separate institutionally these two things. A little bit the reactions that we are seeing on the continent is that those institutions are trying to do the right things for their beneficiaries. But at the same time, it doesn't allow us to really translate the little saving we have in Africa investment. So there is one of the consequences of this is you have currency mismatch in our investment, you have maturity mismatch. That's what part of the investment in Africa in infrastructure is so expensive. People are financing with short-term resources, long-term investment which have long-term return, are investing in currencies which are foreign currencies and therefore bear the currency risk. So there are two important risks that we are facing here in Africa. So as we are looking at it, I think that it's a high time to start now thinking about institutions. We will be looking at assessing the various types of risk. Various types of risk which come from the sovereign political risk, sponsor risk, construction and completion risk, operational and supply risk, demand and price type of risk, financial risk. All these type of risk need specific institution which will be looking at it and assessing that risk in a transparent way to give the right signal to the market. I remember more than a decade ago when I was myself in government, it was one of the challenges for the sovereign debt of my own country. We were not sure that the sovereign debt of my country, Senegal, was measured in the right term. So we did a sovereign credit rating at that time, and it helped us a lot to go to the market and show really the risk attached to the sovereign risk. It was that exercise was repeated in other places in Africa and yield result. So the same work that we did on sovereign debt, that's a little bit what I would like us to start thinking about when you are looking at investing in Africa, in infrastructure in particular. How can we start building institutions with the private sector and the public sector to have a way to assess the different type of risk, translated in indicators which are easy to understand, easy to capture, so that when people are making decisions, they can do that. I will finish by saying that, like President Kaberuka said rightly, there are a lot of interesting things which are happening right now in Africa. Azito, the Bédié Bridge in Côte d'Ivoire, the wind farm in South Africa, the toll road in Senegal. All those are very interesting initiatives. And it happens that in all these initiatives, the World Bank and African Development Bank have been working together and structuring those. And what we are trying to do is to strengthen our guarantee instrument, MIGA, use the PRG, and the private risk guarantee, and also to try mobilizing other type of resources which allow us to invest. So this is what I think will be an excellent way to look at in that panel to, as President Kaberuka said, looking at what works well, but also to, in addition to that, to start thinking about some institutional organizations that will allow us to capture more precisely that risk and try to price it in a more transparent and objective manner. Thank you.
Fantastic. Yeah. Thanks, Maktar. I think that's really going to tee us up very nicely to look at solutions, to be forward-looking, and the types of innovations that we really need to employ to de-risk and create correctly price a lot of our assets and opportunities as they relate to infrastructure. And with that in mind, I'd like to turn to Mahesh, because prior to joining the panel today, we've had a lot of ideas that have been percolating about how to really create instruments that are working in other parts of the world, instruments that are working and could work in Africa. And Mahesh, I'd like you to just sort of share your views on the type of structures that you think represent solutions in terms of de-risking and reducing the perceived riskiness of investment infrastructure.
Thank you, Hubert. My background for disclosure purposes has been in capital markets and in ratings and in structured products and in financial guarantees. So I come to the matter at hand with those experiences. The first point I would raise is what the Vice President Diop said. A decade ago, Senegal looked at itself and decided that the perceptions of risk surrounding it were inappropriate, and it corrected that by going to a rating. A decade ago, when you went, there were very few countries rated, maybe 3, 4 or so. Today, there are nearly 25 to 30 countries rated. In Africa, there's still 25 or 30 to go. That has enabled many of them to access the capital markets up to a tune of around 10 billion over the last couple of years. So perceptions have been pierced through the ability of an investor to compare a B-rated credit or a double B-rated credit with other similarly rated credits across the globe, not just in Africa. I think a similar step could be taken if the IFIs were to encourage the use of ratings for structured project financings. These are more difficult to rate than sovereign governments, but they have been rated, and perhaps a greater use of them ratings could be made in African infrastructure financings than has been made globally, because the needs here for piercing the perception gap is great. The other point I would make is the difference between perception and reality is a function of both perception and reality. So the gap can be reduced by improving the reality. And the reality can be improved in long-term ways, but perceptions can be improved also through better selling of your credit. Very often, borrowers who go, or countries who go to US, for example, which is where I live, they will go to Washington and talk to the U.S. government and to OPIC and Exim Bank and to the World Bank and others, but they fail to go to Wall Street. It's very important to go and sell your wares, to sell who you are, why you are interested in financing, how good you are, or how you're improving if you're not as good as you want to be, and explain it over and over and over again to investors, because it takes shoe leather to sell your credit. It doesn't just happen overnight. It's not a simple story. It is a story that has to be told over and over again. I've been involved in fundraising, and I'm amazed to see my colleagues who can tell the same story with a degree of some spontaneity, which is just amazing. They've told the story 100 times, but they can tell it as if it's the first one. And you have to learn that skill, to have shoe leather and to tell the story because you believe in it. And it's right. That's how you break the perception gap. As to instruments, I think you want me to save that till later, right?
Okay.
So that's my first comment.
But on a practical level, I just want to stay with you a second. What's the recommendation? What do you think we could do better or more of, as you say, to engage the Wall Streets, to engage our own capital markets, so that we can arbitrage the opportunities for a massive investment opportunity around infrastructure and our capital markets?
Well, I think Africa is a great story to tell, but Africa's great stories are really in some countries that are doing well and in some projects that are doing well. So we need to be able to share with investors around the world the stories that are good and say, look, please make a distinction between those and others who are still developing. Africa has many states that are not still there where others are. So we have maybe 18 countries, I don't know how many, that are doing reasonably well and have been for the last decade plus. we have many countries that are still struggling with security, and they sometimes drive perceptions. So if we persuade the markets to make a distinction between one country and another, and say, look at one country on a standalone basis, look at East Africa, for example, as a community that is coming up, that is protected by its common interests and common structures that are coming up. West Africa is a regional development. We can look at that. Please look at us as a consortium of countries where maybe some countries might do not as well, but overall the region is doing better. So if there's a better distinction made, then if a Mali happens or something South Sudan happens, people say, well, you know, that's South Sudan because Uganda is doing fine next door. You know, and Kenya is actually doing things about things across the border. So there are stories that could be told that say, look, Africa is not just one mosaic, one painting, it's a mosaic. And let us learn to distinguish among African countries and African projects so that we assess each particular risk that is brought to us on a standalone basis and make a judgment about risks and returns. I think part of the reason the returns are high is because investment level is low. As a result, the best projects get picked up. And in fact, MIGA has been a great guarantor, but frankly, MIGA doesn't guarantee enough. MIGA has had no losses. That means you're not taking risk. Yeah, so, and MIGA's guarantees, okay, they amount to about $2 to $3 billion in Africa, but the needs in Africa are huge. I come from the financial guarantee industry, which guaranteed $3 trillion of debt before the guarantee industry was met its maker, essentially, during the financial crisis. It's still surviving, but on half a leg. Anyhow, that industry guaranteed $30 billion in emerging market financing, more than the total of all the multilateral guarantees put together. So the private sector can be very powerful if you harness it in order to provide investors with what they want: simplicity in the investment decision and safety and security. So a simpler guarantee structure from the financial markets involving the IFIs or without would be a very good idea. I helped set up a company like this in Asia, and it could be set up again for Africa.
Thank you, Mahesh. And I think, you know, the bottom line is there's nothing to invest in unless you've got a good developer who is really being able to focus the message and talk the investment vernacular. And I'd like to hear from you now, Helen. Just you've been associated with a number of successful funded energy investments in the continent. How did you go about that? Clearly you met a number of, how can I say, not supporters, people that weren't really very supportive of the story for one reason or another, perceived versus actual risk, what we're all going to continue to talk about here today. But how did you overcome that? And what would your advice be about creating more of these successful projects based on your experience?
Thank you, Hubert, and thank you to the African Development Bank and the President for inviting me to speak. I am the head of a classic, small, independent power business. We only work in sub-Saharan Africa, and that actually probably makes us unique. Why we do it is a long story, but it comes down to history and to a real love for the work we do and a real feeling that we need to meet the needs of the people of Africa and providing them with power. And I won't say it's easy. I do get very impatient when I see discussions about African risk. Our projects, thanks to the African Development Bank, the World Bank, and the DFIs in particular, they are project financed. That means they stand or fall by their own returns. There's very little recourse to the parent, which in our case is just as well because we're a small company and we don't have huge resources. But if you look, and I'm picking up now on what was just said about the rating agencies and whether there could be products put in place supported by the rating agencies to mitigate risk. We saw last year that Moody's produced a report on the fate of about, I think from memory, 4,000 project-financed infrastructure projects and other projects around the world. And of those 200, just about 200 that they looked at were in Africa. Do you know how many defaults there were? 1. So the perception in that sphere, the perception and the reality are poles apart. Why investment is not coming to Africa, I think, is down to a variety of reasons. Infrastructure is a particular problem in that the development phase is a high-risk activity. Some projects will fail in the development phase, and it's also a very, very protracted activity because project finance, as you all know, is not simple. And it takes time to tick all the boxes. And I have to say, I have said in another context that in project finance we've created a bit of a monster in that it gets bigger and bigger and more unwieldy as time goes on. And that's something I would like to see us address as we go forward. But why are we not seeing, for example, institutional investors around Africa investing in our infrastructure projects? I think a lot of it comes down to the stage of the project at which an investor is able to invest. Institutional investors cannot invest in high-risk early-stage development. They're not set up to do that. So we as sponsors, with the help of our funders, we have to find a way of doing that. But once these infrastructure projects have gone through construction, and for a power project such as I do, you could be facing a period of 4, 5, 6 years in development. We're working on a project now which is pretty well known, a wind project in Kenya, which is being supported very, very strongly by the African Development Bank. That has been in development for 6 years. It still has not reached financial close. It will then be another 3 years in construction. So the early investors are waiting 9 years before they see their returns. That's not a job for institutional investors. But once it starts to operate, that's a different story. Long-term, stable, not particularly exciting returns characterize these projects. And so it's a question of looking through the hype and looking through the perceived risk and seeing where these risks actually are and using different instruments and different ways of handling those risks in the project cycle.
And in that context, we're seeing in the market, and I think we spoke about it earlier as well, that a lot of the infrastructure funds are now understanding that they have to create their own pipelines and build the investable projects similar to what Donald mentioned around Africa 50 funds. Is this a practice that you would recommend in terms of, you've got an infrastructure fund, maybe it's $500 million to $1 billion or even more than that, X% should be put aside so that you can invest on a venture capital basis in project development. Do you think that would have an impact?
Absolutely. The single most difficult money to raise in the infrastructure field is development funding. So I warmly welcome Africa 50. I think it's a marvelous venture. Taz is going to tell us more about it. One or two, the World Bank has the IFC Infraventures project, and they are investing in one of our early stage projects on a kind of similar basis to venture capital. The DFID has funded Infraco in the UK, and they do something similar. So there's the old saying, if you present enough intelligent people with a problem, they'll come up with a similar answer. And so this is beginning to happen, and it's of great benefit to the springboard for developing more infrastructure projects in Africa. But if I could just add one more thing before Hubert shuts me up. I do think that success breeds success. So the more we do successful projects in the infrastructure sphere in Africa, the more we will tell the outside world, look, it can be done. There are examples. Come and see.
Superb. And I'm going to move to the new class of investor because you can't talk about infrastructure investment looking forward. Everyone's focusing now on pension funds, sovereign wealth funds, the type of long-term view that you can take. Can you just tell us what your view is on infrastructure? Because we know that, for example, the pension funds' assets are projected by 2050 to be in the region of 7.3 trillion. Sure. Now, the question is they're going to need bankable structures and projects, and it'll be interesting to hear your views about how you sort of de-risk and engage other institutions to actually see the opportunity as opposed to the perceived risk.
Sure, thank you very much. Maybe I'll start by helping you quantify this perception of risk. An institution like us, like the NSIA, can do three things. We can invest, we can co-develop, and we can sponsor. Ideally, we would like to just invest. But when we started, we realized that investing will mean there's a pipeline of things to do, and then we had to back into co-developing. And at the moment, we have things in our pipeline that we are sponsoring. But at the co-development phase, to quantify some of the perception of risk is most of the people we reached out to for co-development would require 3 times return on the development funding, just because of the risk that 1 in 3 of those things will probably not make it to reality. So this is the perception, and this is the actual number. The reality is also, as much as you like to sell the fact that you get 15 to 20% return in dollars during operations within the typical infrastructure projects in Nigeria or in Africa, against 7% in the developed world, the reality is that there is still not enough of these things, in my opinion, for people to feel comfortable enough. And I can speak from our perspective, there isn't enough of those things for us to feel comfortable enough to actually move in big time into this asset class. But we have been forced, 40% of our assets at the NSIA is now invested in Nigeria infrastructure, will be invested in Nigeria infrastructure. To solve these problems, we've done the following 3 things. The first is we've dedicated 1.5% of the entire asset class to project development. And I think we are going through that process in 2 projects at the moment. The anticipation is that it will take us somewhere about 2-3 years to finish the development phase of some of these projects. We're about 18 months into 12 months into one of them. And then we will start to invest. You have to do that, otherwise you'll never have enough to do. But my encouragement to African countries will be, what brings about the perception of risk is lack of information. One of the roles that capital market plays is the role of price discovery and market discovery. There are assets that we have today that can be monetized by putting those assets in the market via an infrastructure bond or via listing. With that, people will start to feel they understand the characteristics of this. There are toll roads in some African countries, in my opinion, that should be in the market already, completed. But these things are not being run in that way. Until you do that, you will never be able to get people to fully understand the cash flow characteristics, the risk of some of these assets. And that's the first thing that needs to be done. When I think about African infrastructure, I go back to my early career when I was at Goldman Sachs Asset Management as a technology portfolio manager. This was in the late 90s. .com had just started. No one knew how to price them. No one knew how to invest in them. But today, obviously, Facebook is valued at X. 15 years ago, you couldn't really value these things. But it took 3 or 4 or 5 companies, and eventually we created an asset class, and then we understood how to invest in it. So one of the first things we need to do is some of the successful projects need to be on the market. We need to understand it publicly, and then people will start to understand how to invest in this thing. The second thing, in my opinion, I think needs to help reduce that perception of risk from our own perspective is that we need to create more institutions. Mahesh had mentioned earlier about some of the insurance products, and we talked about this over lunch. One of the things we've been trying to push is the creation of certain insurance products that will actually attract people, not just us, but also pension funds. These things, we're talking as if we're selling these asset classes to external investors outside of Africa. The reality is that you may never be able to sell some of these projects to pension funds in Nigeria or pension funds in Africa. Let us start by trying to sell these things to ourselves, first of all. And to do that, my sense is, what do we do to get pension funds to participate in this asset class? Now, I don't want to have my own pension fund put in a development project that is not properly insured. So do we start by creating a tranche that is insured for pension funds to participate? I think that's one of the necessary institutions that needs to be built. And I understand monoline insurance have a very bad rap at the moment, but the reality is that I think to start to season this asset class, it's important to create this kind of products that brings our money into it before we start to bring other people's money into it. And then finally, I think the regulatory environment needs to be seasoned. Now, there's a lot of laws and regulations that have been passed. You can never tell the reliance of the regulatory system until it is tested, right? And I think this is where it starts to get really interesting. In Nigeria today, I haven't seen one power project that has gone to the market. They should come. And then we can actually look back and understand whether this has actually been successfully regulated. My sense is these things will come. The time will come, but it's going to take a little bit of time for us to, let's not be in a hurry with some of these things. It's going to be a little bit of time for us to actually feel comfortable enough to now start to attract the kind of capital necessary. So, like I said, the perception is there. The numbers are there to quantify it. 3 times return on development is what people expected from me. Twice the returns on operations. And I think that some of these things we've kind of discussed, I think, in my opinion, that will start to help us reduce the perception of this risk.
I mean, in terms of being able to unlock the pension fund wealth as well as the sovereign fund wealth. I mean, it was put to us the other day that there's a country on the continent. It requires about $8 to $10 billion each year to deal with its infrastructure deficit. It's got about a $25 billion pension fund asset base, but not 1 million of the 25 billion can be invested in infrastructure. I mean, from the private sector side, one can develop the projects, one can put in place the innovative structures. Right. And I want to call on both Donald and Mukhtar to give us their views about how a partnership can be formed between the public and the private sector and our regulators to really begin to find ways to unlock the mismatch in terms of the assets that are there with these institutions, the infrastructure deficit, and we can then begin to employ our capital markets more profitably.
Sure. Thank you so much. Listening to my colleague on the right, maybe I should keep quiet because she said everything. First of all, this Africa risk thing, you're right. I was reading a paper the other day in a European country when there was this Ebola outbreak in Guinea. The title was not Ebola in Guinea, it was Ebola in Africa. Mm-hmm. Now, I said to myself, these editors know the world. Mm-hmm. These are not people who are ignorant. They're interpreting a certain view of the world of this continent. So I don't think we should waste so much time on that. We should waste more time showing things which have happened. And this is an example which I can give as well. I was told of a story just before the financial crisis of a company, no name, which divested from Cote d'Ivoire, thought to be risky. Guess where they invested? In Cyprus, before the financial crisis. Now, guess where they lost money? Mm-hmm. So, another perception. We shouldn't be worrying too much about those things. Mm-hmm. Those who make those choices will lose money. Mm-hmm. Another example, I was talking to pension funds in a Scandinavian country, trying to interest them in Africa 50. This was said, President, please, we invested so much money in the Spanish renewable energy, and we got banned. So we don't want to go south of Spain. And I said, actually, you should go south of Spain. Mm-hmm. This is where the money is to be made. So there is a gap we have to close. It will be closed at some point. But perhaps, as you are saying, we are spending too much money on this Africa risk, too much time, instead of getting things done. Like this bridge in Abidjan, which I've done with World Bank, IFC, and many others. Like many projects in the middle of Dakar, the airport, the highways, a lot of energy projects in Kenya, which we are doing. We have participated in Nigerian power deregulation by putting in partial risk guarantees, I think $20 million to help the system happen. So things are happening, and that's where we should focus. Those who fear to come, tough luck. But I think we should focus on things which are working. Second point, let's not fool ourselves though. We still have a lot of work to do. Because an investor putting the money in this infrastructure as a new asset class is investing in this physical thing, but also is investing in the trust of the public sector behind it. That it will not change goalposts in between. That the regulators are independent in law and in fact, not simply independent in law, but when they are tested, they fail to meet the standards. Those things we have to work upon. And governments have to give comfort that these things are happening. So that's why I think the African Development Bank, World Bank, IFIs really must step up in between to try and be like a bridge between the investors and the governments to get them to do the right things. Even if that means we may agree to do things like first loss, to develop projects up to a point, exiting later, as the task will be telling you. So we have a role there. Governments must do some things, we in the IFIs. But I do think that if investors see a return and they can trust policies behind it, they will come as they are doing already in energy. Final point. Let's face another reality. There will be infrastructure projects which will always require public money. No private sector will come close to it. That is a fact. We'll fund those from taxation or from some other sources. We have projects which already attract private sector money without us, because the numbers add up. Telecommunication, IT-related issues. I think we're worried about the space in between. How to get these projects ready, which we want to do in Africa 50, and by the way, bring them to fruition, and then at some point we exit, then you can do some other things as well. So I think we should not waste too much time on risk. It's about what can we learn from things which have worked, what is the role of government, what is the role of the IFIs. Also, I think pension funds, my brother, I think the regulations I've seen around pension funds, African pension funds, will have to evolve as well. Some of them have mandates which are so restrictive. They'll have to evolve. So for now, many of these African long-term saving pools, they prefer to invest in American 10-year treasury paper, get 1.5%, because they feel they're more comfortable with risk, with liquidity, and things like that. So, but I think they should open up a bit. They are beginning to open up a bit. I think small percentages, but I'd like to see higher percentages investing in African assets.
Superb. Makta, I'd like to just touch on this same point and get your views on some of these practical things. Where should we focus? How should we focus? And there's also this suggestion that we really need to take a bit more control over our own investment profile. Because right now it's typically the international rating agencies, but do we have an agency in the continent that can actually talk to the risk and complement and question, in some respects, some of the international perspectives on perceived versus actual risk? Do you think that's a worthwhile exercise?
Now, what is fantastic in this panel is that there is so many points of view and so many angles that are complementary in addressing that question, that I think that I see this panel as the beginning of a process where we need now to break down these discussions in very practical terms. And I think everything I heard here makes individually sense. Individually, it makes sense. So the question is how to put everything together to tell a story to the market. I think President Kaberuka is right. I think it's time to revisit some of the elements of the pension regulation. But I think there is a story to it. In the past, not a long past ago, 25 years ago, government could come and raid the reserve of a pension fund and decide on a stroke of a pen to really invest that money in investments which are not productive. So the reaction when people were reforming that economy was to say, let's protect as much as we can those assets so that there is institutional building. I think the pendulum went to a point, and now it's time for it to come back a little bit more in the middle as our institution, our policies are becoming more and more consistent, more and more long-term policies, and we have a track record where policymakers in Africa are shown that they're doing the right things in terms of macroeconomic policy in building institutions. So it's time, and I fully agree with President Kaberuka, it's time now to revisit a little bit the institutional framework that were put at that time to protect institutions against wrong policies, because now there is a consensus around right policies. Secondly, I think that there is two questions that are object of panels during this annual meeting, which are very linked to what we are discussing, is peace and security and demographic dividend. I think all these questions will also affect. The more we will have an aging population in Africa, the more pension funds need to have higher return in their pension to be able to really pay the pensionees. So this also is a pressure on pension fund holders to find asset class which is really yielding the result they need. Also on the possession side, I think I really salute the decision and the approach of African leaders today to start thinking about conflict in terms of regional solution to conflict. Because the externalities of a conflict in a country is massive. As has been said by all panelists, if there is one conflict somewhere in Africa, it affects the perception of the continent. So the faster we address that conflict collectively, the better it is for us to reduce the perception of risk in our country. Practically, I think that we need to build institutions in Africa, private sectors, support all these institutions on rating to be able to tell the African story with in-depth knowledge of what is happening in Africa, because in reality, you will never have armies of people in Wall Street of a city in London looking at the economy and the risk of African countries in details as we want them to do it. They will not allocate those resources for the time being. So we need to use the resources available and the competency which is massive in our continent to be able to have those institutions for the private sector and the private sector. So every initiative, an idea of building those institutions, I will be extremely supportive, and I will try to really make sure that our institutions support the building of this institution. Third point, all investors making the decision and the portfolio decision are looking at what is reversible and what is irreversible. So irreversibility, and as we are moving to infrastructure investment, we are more and more going towards the type of investment which are becoming irreversible. You cannot, unfold it and go out of it. So the level of insurance that people require is even higher when we move in infrastructure. So that's the reason why I think that we need to also continue increasing the level of guarantees of insurance from the private sector, public sectors, to offer to investors for them to come in that sector, being local investors, being investors from abroad. That's also another thing that us public investors, international organization and development organization can do. And lastly is a point that, and I will repeat really the point that Donald started with, is how we can help the developers. Because this is where, at this stage, a lot of the risk lies. It's been repeated by everybody in the panel, that is where it's more difficult to put your money. So we need to really support the developers to be able, by bringing the resources we are bringing, but to bring more resources to the developers for them to be the first movers and give the signal to the market that this type of investment are productive, are less risky, and have other institutional investors come after. So there is a greater role that we can do to support you even more in developing projects that are in Africa and tell our story, which is very positive. And I think this is the beginning of telling our story loudly and clearly. Africa is on the rise.
Fantastic. So I just want to, you're the developer on the panel here, Helen, and we talked earlier, in fact, around the spring meeting, we had a session that looked exclusively at how to create large Pan-African companies operating and investing across the continent. And we obviously see infrastructure as a well-suited asset class and sort of space to do that, but we actually realized that most of the developers on the continent only operate on a single country basis. What sort of support do you think the IFIs could really do to help scale up and take some of the developers regional?
I think you're looking at two different phenomena here. On the one hand, there were, back in the late 90s, at the beginning of the 2000s, there were large infrastructure investors looking at the African continent as a whole. I worked for one. And then things went pretty badly wrong in the Asian financial crisis, the problems that the energy companies particularly had in South America and elsewhere. And those big utilities from the US, from Europe, have pulled back. We're not seeing them at all, really. Recently, there's been a project announced in Namibia, and one or two of the big utilities, such as EDF from France, they've dipped their toes in the water. But on the whole, we don't see them. So that's one area. Most of the developers working on a Pan-African basis, like ourselves, are quite small. Secondly, you see a phenomenon which is that of local investors, local developers, seeing a huge need. Seeing a huge need for power in their country and starting to embark on developing a project, not realizing the complexities that are involved if they're going to finance that project and get it off the ground. So they then quite often come to the African Development Bank, the World Bank, IFC, or indeed the European DFIs to look for support. And that support can take a number of forms. But typically, we've found they send them to us or to our few competitors. So there is work to be done there, I think, to support local developers so that they understand what has to be done. If they're going to embark on project finance, which we discussed earlier, is an onerous way of financing a project. The good thing about it is, once it's done, it's a very strong structure within which the project will flourish. My old boss at AES used to say, if you project finance your projects, you will probably do fewer of them, but they will survive. And I think that's a good mantra.
So a new way to finance project preparation, I think, is sitting now to my right. Her name is Taz, and we've heard just a little bit about the Africa 50 Fund. But please expand on how you're actually seeking to invest in the project preparation piece.
Okay. Thank you, Hubert. Actually, Africa 50 will not be only focusing on project development, but Africa 50 will be accompanying projects from day one, means that from idea to all the way to the operations. Because as you know that African Development Bank, through its private sector window, was investing into PPPs or private infrastructure projects for the last 6 and 7 years. We actually invested in 49 projects, and we put $3 billion from our resources. And the last 3-4 years, we also started the syndication, and we raised actually $4.6 billion from the market. So total project delivered was $32 billion, and it was an amazing experience. As Helen was saying earlier, we have 49 projects, and we have 0 write-off. This tells you about project finance. So our experience showed that actually in Africa, when you analyze that 49 projects and other projects in the market financed by other financiers, for a project from idea to reach financial close is 7 to 10 years in Africa. Most of the time, projects, they come to us, people or investors, they think, or governments, project is ready to go for financing. But when you look at the structure, when you look at the contractual agreements, you note that everything needs to be restructured. This also causes delay. This causes some additional time. So we decided to accompany projects for the development and bring our experience and also technical knowledge and also convening power and our relationship with the governments. And our goal is through project development component, bring that time frame from 7 to 10 years to 3 to 4 years. How we are going to do this? First of all, let me touch something very misunderstood in the market. That is project preparation, project development. Project preparation is actually only feasibility studies and maybe very early technical design. When you come to the project development, which requires substantial resources and capital, when you look at any project in Africa, the project development cost is almost 10 to 12% of the total project. Means that, let's talk about one project we worked together with Helen, which is around $560 million. While the project preparation normally is misunderstood and it is thought that this is all needed for any project, is actually $3 million. Feasibility studies and early designs. But when it comes to the development capital, which was $54 million, this tells you that there is a huge gap, as Hubert was saying earlier, the venture capital to come to this market and take the risk and develop those projects further. That's where Africa 50 will be coming into the picture. We will be partnering with governments, whom they have financial difficulties to putting those resources into every single infrastructure projects they would like to deliver, or private companies and private investors to co-develop projects. We signed an MOU recently on a very large railway project, and today, actually, we will be turning that, signing a term sheet financing agreement, which is a $15 billion three-country railway. How we are going to co-develop this project? Each of us, 3 countries, and African Development Bank's Africa 50 will be equally sharing the project development costs. In the first stage, each of us, we will be putting $2 million, and with $8 million, bring the project to 30 to 40% completion of the synchronization of all the documentation. Then we will be bringing more development capital and bring the project almost 60% completion and invite private companies or strategic partners. Means that when we reach the financial close, governments and us, we will take our project development capital and plus the premium and go to the next project. As such, continuously, we recycle our development capital and then deliver more projects. Alternatively, each of us, we can also take longer approach and we can turn those development capital into equity in the project, at least maybe until the end of the construction period. Once the project is actually reached the end of the construction period, it is very easy to bring other financiers. It could be pension funds, it could be sovereign wealth funds, or we can basically bundle those projects and go issue a project bond and sell to central banks. Today, we know that central banks are actually investing in very low return assets. So therefore, actually, we will be opening a new way of investing for the central banks and using the local resources in the continent. We also looked at the project finance. And we noted that through our 6 years, 7 years experience, and also 49 projects. Most of the time, project reaches almost the financial close. What you are missing is 5% equity or 10% equity, or maybe 5% of the debt. All of us, we go through a number of parties to get more resources or close the debt gap. And taking the time of due diligence into account, another 6 to 7 months delay in the projects. Why not Africa 50 steps in, closes that gap, and construction starts, and project is slowly de-risked, and we go to the market and sell the equity or the debt, and we close the gap. So actually, we also looked at a number of other products we will be offering under the Africa 50's long-term financing tray. And the idea is facilitating projects and making them reaching financial close as quick as possible. Africa cannot afford to wait for one project to come to the market for 15 years.
Particularly when we have such a large and active group of supporting partners who understand the opportunity that infrastructure can unlock. And I think I'd like to engage you more from the floor now. So I'd like to open the floor for some questions and answers, obviously in keeping with the theme. I think we're trying to orient around solutions to drive down the perception of risk in terms of investing in infrastructure on the continent. But more importantly, any success stories that we can borrow from or replicate and extend will be very useful. There's a microphone here. If you could identify yourself and who you're directing the question to. Thank you. Can we have a microphone to the front, please?
Hello. Yeah. Hi, my name is Arun Kumar. I'm from Frontline Dubai. It's a project development company working on some of the projects in Africa. My question is to TAS on railway project, about $15 billion project. What is the business model you are looking for this project for private investors or EPC contractor to step in?
Well, as I mentioned, actually, I shouldn't get into these details. You asked me this question last week in Abuja as well, and I'm going to have the same answer. I think you are going to wait a little bit for us to co-develop this project with the governments and bring to the market. But we all know how the railway projects are working in the world, actually. We know that substantial public resources are needed to make the project interesting, and obviously we will be looking some other projects around the railway project so we can integrate them into this project, which will be making the project more interesting actually for the private sector parties in the future and also strategic partners. So you're going to be a little bit patient for us to give you a more specific answer on this.
Okay. Another question, hopefully a new one this time. Could you raise your hand, whoever? Oh, yeah. Thank you.
Hi, my name is Astrid Kimball. I'm from OPIC, the U.S. government's development finance institution, and OPIC has been investing in Africa for over 20 years in infrastructure successfully. I wanted to ask the panelists about how they work on the enabling environment and work with governments directly on some of the policy issues as part of President Obama's Power Africa initiative, which is across the continent. We're working very closely in the U.S. government, but we are curious on your perspective. Thanks.
I don't know who would like to take this one. Makta?
Indeed, I think that looking at the overall environment is critical but more importantly, to increase the size of segmented markets that we have in Africa. I think that this is certainly one of the obstacles that some of the investors are facing because in all these investments you have some sunk cost, some fixed costs that you have to undertake, and if the market size is too small, it is a deterrent for you to come in the market. So everything that can be done, that for me is the very essence of the regional integration programs that we're trying to push, to make sure that the environmental, the policies framework is consistent. Let me take an example. If you take today, Tess has mentioned some of the project. Let's say, for instance, one project that we work together on the toll road in Dakar Diamniadio. It's a good example where you have very similar institutional and legal framework in that sub-region, and it will be a shame that an investor has to start again from scratch institutionally to build, look at the PPP laws and work with new PPP laws if he has to replicate the same investment in a similar country with institutions which are very similar. So one of the objectives that we're trying to push is to try to harmonize the policies at the sub-regional level and look at the sub-regional entities. Secondly, in terms of stock exchange, it's important that all the stock exchange that we have in Africa, which are coming up, be able to have mechanisms to really communicate and work together, so that if someone puts something on the stock exchange in Abuja or in Lagos, he can also have that asset also both in Nairobi or other places. So there is something about increasing the size of the market to start now reducing the cost of investment. Secondly, I think that there is a kind of collective action process because of what I would call the contagion effect that we have in Africa. If you have in one place a reversal of policies, it affects the whole continent. So I would advocate that as the policymakers have been moving at the policy front on a peer review mechanism, where each of the policymakers is looking to other one and say, you cannot do these things because it affects us, and if you are doing this, we have a mechanism for you to come back to the group of policy. I would like to start thinking more and more on the economic front, on the institutional front, on the regulatory front, to have a kind of peer review mechanism which allow us to reduce the risk of reversibility in our policies, which have an asymmetric effect on investment, because you just need to have one of them to have basically to make 3 steps backward and come back.
Mahesh?
Yes. I think it's good to have solidarity across the continent so that if there's a problem in one part, perhaps there's action taken to help fix it. But I think it's also important to recognize the good performers from the not so good performers. The markets will do that. The markets distinguished in the Asian financial crisis between Indonesia, many of whose projects had contracts on which the country reneged. And it distinguished between those and project countries like Malaysia and others that honored their contracts. People have memories. Investors have long memories. So each country has to stand for its own rule of law, and if it does not perform, then I think it will be punished. And it should be if it does not honor contracts. On the other hand, that should not taint the reputation and the credibility of the country next door that honors its contracts. I think the markets are able to make those distinctions, and as project volumes rise, they will in Africa too, and they should. But I think the point is well taken that if there's a problem in Mali or in Ebola in Guinea, that distinction should be made that is where the problem is. It's not really spread out all over Africa, and then help should be provided to the extent possible to fix those problems on a consolidated Africa-wide basis to the extent possible, and through other assistance that might be available. Investing is a very individualistic business. each investor is investing his own money with his own fiduciary governance structures. It has its habitat. Some like risk, some like low risk, some like liquidity. Likewise, the borrowers have to be themselves standing on their own feet. And if there are good stories to be told that they have to tell, they have to beat the market down and say, look, my story is good. My neighbor may not be good, but don't blame me for it. Mm-hmm. So I think some degree of individualism and flogging your own story is very important.
Superb. And Helen, on the Power Africa side, as a power developer?
Yes, well, there's a Power Africa session tomorrow, so I won't try to replicate what's going to be.
You heard it here first.
All right, you got it first. I think what we're seeing at the moment, there's a very interesting example of it. I'm not very good at philosophy. I like to get down to brass tacks. I develop power projects. What we're seeing in South Sudan, I think, is very interesting. We signed yesterday the equity documents for a power project in South Sudan. Last week, the African Development Bank also committed funds to the government of South Sudan to develop the distribution system in Juba that will take the power that we will produce. Now, I should imagine half the people in this room think we're probably demented. Why would you do a thing like that? The fact is, firstly, it has enormous developmental impact. And that's the main reason. But we are a commercial company. We see an opportunity. Other people see a risk. We see that this is a place we want to go because that's a really good project. And we know we can do it. We can structure it well. And with the off-taker supported by the African Development Bank, what's not to like? But at the same time, thank you. But at the same time, the other thing we're seeing in South Sudan is that the regional governments are coming together and they're encouraging the South Sudanese to find a solution to their problems. That's coming not just from within South Sudan. In fact, some people might say not enough from within South Sudan, but it's coming from the whole region. And that's a hugely positive development along the lines that have been mentioned.
Superb. I have a question here at the front.
Merci. Je vous remercie. Je suis Luc Oyobi, ministre de l'Agriculture du Gabon. Il y a un an, j'étais encore ministre de l'Économie, lorsque le Fonds 50 Afrique avait été créé. Nous avions pour la plupart des appréhensions. Mais je note aujourd'hui qu'une année après, ce fonds semble être bien lancé. Alors je voudrais savoir quelles sont les conditions que propose le Fonds 50 Afrique en termes de taux d'intérêt, en termes de durée d'amortissement. Parce que nous savons qu'il y a quelques bailleurs de fonds, notamment venus du côté de l'Asie, qui nous proposent des financements avec des taux d'intérêt de 2% et des durées de 10 à 20 ans. Donc ce serait intéressant de savoir ce que nous propose le Fonds 50 Afrique par comparaison à ce qu'on voit du côté de l'Asie. Je vous remercie.
Clearly for you, Taz.
Well, thank you for the question. This gives me opportunity to talk more about Africa 50. Africa 50 will not be as a public finance institution. It's not going to provide very cheap loans or grants to governments. Africa 50 will create partnership with governments and also with private parties to develop projects further and later finance. So the projects Africa 50 will be financing or co-developing, they are going to be mostly large transformational projects, and they are all commercially viable. I would like to give you some example. I mean, Mukhtar Bah mentioned the Senegal projects. I think we work very closely on those projects. And each project, actually, when you look at what they provide to investors, it is 18 to 20% return. So I think we should not really focus on cheap credit or cheap loans, long-term loans, but we have to focus on delivery of high-quality projects. They are sustainable. We mentioned that actually all our projects, 49 of them, we don't have any write-off. Most of them are operational. So this tells you that none of those projects actually financed through public sector window of the African Development Bank. They are not really provided with no interest or 1% or 2% interest, but they are game changers for the countries. I believe that the Senegal example created a huge impact in terms of investment opportunities and also appetite in the continent. Because when you look at the whole Senegal story started in 2009. In like 2 years, all of us, we worked so hard to make 1.3 billion euro investments a reality. When you look at 1.3 billion euro investments all happen in Senegal, actually, they wouldn't happen if we were thinking that government should be borrowing long-term and delivering those projects. It wouldn't happen. I always actually ask this question, if you can tell me, 1.3 billion euro investments, how much was the government's contribution? I can tell you how much was it. It was only early project preparation, which was less than 10 million, before the concessions, and also it was $46 million for the Dakar toll road, which was actually for the viability gap funding to make the project attractive for the private sector, which was provided by the public sector department of the African Development Bank. If you look at Senegal achieved 1.3 billion euro investments, only putting less than 100 million. So we should focus on quality, delivery, and also sustainability. Those projects in Senegal, they were all game changers. Why? Because they are all operated on concession basis 20-25 years by private companies. And contractual agreements are set in a way nobody can do any wrong. So we should more focus on actually how we are going to create sustainable infrastructure which is attractive to private sector in Africa. I am not saying that the cheap credits are coming from Asia is not needed. Everything is needed. If we look at today in Africa, every year we need $100 billion investments. 50 goes unfunded. Cake is so big and there's a piece for everyone.
Okay. Staying with that theme very briefly, Mokhtar, can you just tell us a little bit about the Global Infrastructure Facility? Because I think there are a lot of similarities in perspective, but they may be quite different. So.
Yeah. The Global Infrastructure Facility is the facility that we are putting in place to help project preparation. Exactly. Ah, excusez-moi, j'ai été entraîné par la mes amis francophones me demandent de parler en français, donc je vais parler en français. Is it okay? You have translation for everybody?
I believe so. Yes.
D'accord. Donc, le Global, il faut que je trouve le terme en français. Global Infrastructure Facility. Donc, c'est la facilité globale d'infrastructure. Bon, je ne sais pas si c'est une bonne traduction en français, mais c'est une facilité qu'on est en train de mettre en place au niveau de la Banque mondiale pour financer la préparation des projets. On va avoir des projets pilotes qui vont être identifiés dans la région Afrique et qui sont tout à fait alignés aux projets d'ailleurs qui ont été définis dans le cadre du PIDA. Donc certains vont être pris dans la liste des projets prioritaires du PIDA. Et il va y avoir utiliser cette facilité pour pouvoir aider à la préparation de ces projets et justement les préparer pour la phase de développement et ensuite pour la phase d'investissement. Donc il y a une très grande complémentarité entre les instruments que nous avons au niveau de la banque et au niveau de la Banque africaine de développement. Et je crois que la question, c'est que le volume global est insuffisant. Hein? Ce que nous mettons, ce que Africa 50 met, nous voulons tous qu'il y ait plus de ressources qui puissent permettre de faire cette transition, parce que comme on le dit, les besoins sont tellement énormes qu'aujourd'hui le continent peut absorber des quantités énormes de ces ressources de projets de préparation. Donc ce sera, pour l'instant, c'est dans une phase pilote. Elle est dans une phase pilote parce qu'il y a une architecture institutionnelle au niveau de la banque. Est-ce que ce sont des revenus de la banque qui seront utilisés ou bien c'est des ressources IBRD qui seront utilisées? Nous sommes en train de discuter de cela et pour l'instant, ce sont les ressources propres de la banque, les revenus de la banque qui seront utilisés pour financer la préparation de ces premiers projets qui seront mis en œuvre. Et on pourra vous donner la liste les projets qui ont été identifiés pour l'instant dans le cadre du PIDA.
Question here at the front, John Louis. Oh, not John Louis.
Merci. Je suis Souleymane Dirasouba, directeur général du groupe Banque Atlantique et en même temps président de l'Association des banques et établissements financiers de Côte d'Ivoire. J'avais peut-être une petite série de questions à poser. C'était de savoir, en fait, pour les panélistes, quelle pouvait être la position, en fait, ou l'impact de l'inclusion financière au niveau du financement des infrastructures. C'est la première question. La deuxième question, le constat est que de plus en plus, les groupes bancaires régionaux, soit les groupes bancaires panafricains, s'intéressent de plus en plus au financement des infrastructures. Et souvent, elles peuvent être limitées dans leurs ambitions par des contraintes liées au ratio prudentiel, parce qu'elles n'ont pas la capacité, même si la trésorerie existe, de pouvoir suivre les États par rapport aux financements qui sont faits. Et les banques locales, c'est-à-dire les groupes bancaires, ont l'avantage d'être sur place, d'avoir l'avantage de la proximité et de la réactivité. Est-ce qu'il ne faudrait pas réfléchir à des mécanismes ou des outils à mettre en place entre les institutions que vous êtes et ces banques commerciales qui sont présentes? Parce que nous avons eu un cas précis, je prends le cas de la Côte d'Ivoire, où pendant les 10 dernières années, la plupart des banques dites internationales étaient frileuses et les banques régionales et panafricaines ont continué d'assister l'économie. Et ça a permis à ces États-là de rester, comme on le dit, debout pour pouvoir assurer quand même leurs charges de fonctionnement et puis pour pouvoir, comme on appelle, investir dans quelques secteurs prioritaires. Est-ce qu'il ne faut pas réfléchir à cela? Est-ce qu'il ne faut pas voir un mécanisme pour que, dans ces réflexions qui sont menées, on puisse voir quelque part la position des banques commerciales? Quand je prends encore un autre exemple, au niveau du Sénégal, le groupe bancaire que j'ai l'avantage de diriger a mobilisé en 2013 500 millions de dollars pour l'État du Sénégal, pour financer des investissements dans des secteurs prioritaires, que ce soit au niveau de l'énergie, des routes et autres. Mais pour aller plus loin, puisque nous avons confiance à nos États, nous avons besoin d'avoir un soutien des institutionnels. Donc, c'était un peu une question et puis une contribution que j'avais souhaité apporter. Je vous remercie.
I don't know who would like to take this one. Any takers?
I understood the question, but I think what you're talking about is really commercial banking support for projects in regional and national level projects, international commercial bank support and domestic commercial bank support. I think you mentioned that in Côte d'Ivoire, you had to rely much more on domestic banking support for that kind of financing. Well, you know, my general comment on that is international, 2 points really. In a country which has difficulty, sometimes economic difficulty or political difficulty, you may have to turn inwards for a short period of time until situation returns to normal before international banks will become comfortable with providing financing, even short-term. Trade financing, for example, let alone long-term infrastructure financing. On the other hand, international banks themselves have come under pressure because of the international financial crisis, and many of them have had to go back to basics to improve their own financial ratios, to go back to their regulators and work out arrangements where they can still survive. So they've had to step back from international commitments. That's changing gradually as banks return to financial health. But the banking scene is still today quite under regulatory, under clouds of regulatory uncertainty. There is Basel III coming. In many countries, many rules are still not fully promulgated by the regulatory authorities. In the US, there's Dodd-Frank. There were like almost 1,000 different rules that the SEC had to come up with. Not all of them are there as a result. some of the banks are reluctant to lend. And I think that shows up quite a bit, not only in lending in their own domestic markets, but also in international markets.
Okay. But Mahesh, in terms of, you raised Basel III, and of course, as it relates to infrastructure, that's a very fundamental change that we're going to have to absorb at some point in the near future. What are the practical changes that because now we're moving towards a much more equity-based institutional investment partner who has a very clear perspective on the performance as opposed to the solvency and the credit side of the transaction.
Well, as you know, in a project, I think Helen mentioned this earlier too, in a project, there are different phases. In the early phase, you need much more the equity and the sponsor funding. As the project becomes more cash flow generating after construction, it can attract longer term debt funds, debt financing to allow an exit for the equity. So banks tend to come in the later phases or in the construction phase. And they are affected by the Basel III requirements, which are much more draconian, and they are affecting different banks at different levels.
And construction companies who can no longer raise some of the finance to put their balance sheets into play for projects.
That becomes more difficult. So that means the shoe leather I was talking about becomes much more important. You may have to go to 20 banks before you find 2. Or 30 banks. You know, I've had friends who have gone to 100 banks and found 3. So it's you know, you keep looking, you'll find something. So it is a difficult job to raise money, and particularly when the regulatory environment is shifting. And that's where a partnership with ADB and the World Bank and the IFIs in finding their partners to come in and bring in some risk mitigation. That's very important because the IFIs have a role in leveraging funds that they have to bring in other partners who have money to play, but they don't know the markets as well. So that becomes very important in arbitraging or in finding solutions despite the regulatory changes taking place.
Super.
Mais peut-être que je peux, à notre ami, l'impact de l'inclusion financière sur le financement des infrastructures, je crois que l'inclusion financière permettra d'augmenter le niveau d'épargne des ménages. Je crois que c'est la relation directe que nous avons. Avec une plus grande inclusion financière, il y a plus grand accès aux services bancaires par les plus pauvres et de ce fait, ils ont tendance à avoir un taux d'épargne qui est beaucoup plus élevé que lorsqu'ils n'ont pas accès aux services bancaires. Je crois que c'est une des conclusions, un des liens directs avec l'investissement. Mais je suis tout à fait d'accord avec ce qui a été dit. Je vois très peu de chances que les conditions de Bâle soient réunies. Déjà, il y a certaines banques dans nos pays qui n'ont pas satisfait à toutes les conditions de Bâle 2. Donc, Bâle 3, alors que les gens sont en train déjà de parler de Bâle 3. Donc, je crois qu'on n'est pas dans un monde où je verrai la réglementation bancaire s'assouplir dans un avenir prochain. Nos institutions, ce qu'elles ont pu faire dans ces situations difficiles, c'est donner des lignes de crédit. La SFI donne des lignes de crédit pour trade financing. Ils le font beaucoup. Et des fois, des lignes de crédit mais je crois que sur le long terme, la ligne de crédit n'est qu'un appui, n'est qu'un moyen d'assurer une situation de transition. Sur le long terme, il faut revenir aux fondamentaux et s'assurer que, bien sûr, il y a au niveau de la capacité du capital, qui est un capital qui est assez fort pour permettre d'avoir un niveau de réserve qui réponde aux risques que le marché perçoit aujourd'hui avec la situation financière internationale. Cependant, la SFI et la banque font des lignes de crédit à certaines institutions de développement en Afrique.
Okay. We have time for 2 more questions before we... Oh, excuse me.
I think just add one comment. I think it's very important what Mr. Diop said about the impact of inclusion, about more savings being available. I think the next step is to just mention in passing that local funding of local capital market and local market funding of infrastructure as a long-term goal is very important because infrastructure has many domestic costs and exchange risks can be quite onerous on projects which don't have local currency, which don't have foreign currency revenues. So I endorse fully what you said about the benefits of inclusion and really the benefits of creating local capital markets and financing vehicles for infrastructure.
Helen?
I think leading on from that, it's back a little bit to the discussion about where you are in the phase of development of the project. But we see in a typical independent power project in Africa, the contract is normally denominated in dollars or euros. And the revenues to the project company from the state-owned, usually, national utility, of course, are in the local currency. And there are ways of mitigating that, and the obvious one is local lending. The problem with local lending has been, traditionally, that it is very short-term, and it doesn't match the tenor of the agreements on which the project is based. There is an initiative, there are several initiatives, one particularly I can think of is Garantco, which is a PIDGE-funded initiative, which allows them to guarantee effectively both the convertibility of the revenues and also the tenor of the debt. But going on from that, of course, another way of mitigating that risk going forward is for the pension funds, because the pension funds themselves have their obligations to their pensioners in the local currency. They're not required to service foreign debt. So there has to be, I think, a way forward in that sphere, and I think we need, as a group, we need to keep thinking about it.
Okay. Taz?
Just to add, actually, when the projects are very well structured, finances are there. I can give you a number of examples, like Dakar Toro, we had a commercial bank. Sandu Power projects in Senegal, we had a commercial bank. Ivory Coast Toll Bridge, we have a number of commercial banks. Means that when the projects are very well structured, they are attractive to commercial banks. So the whole thing is, as Helen was saying, look at the tenor, how we are going to find a solution. Under Africa 50, actually, we are considering some tenor extension type of products for commercial banks. Why don't we just guarantee them 7 years later, we will buy them back? And the 7 years later, project is de-risked. We can basically bundle them. We can go to public listing. As I said earlier, we can sell them to pension funds. We can always find a solution. But main thing is in the early part, how we bring commercial banks for 7 years or 8 years, then we guarantee them. You come and finance this project, 7 years later, we will buy you out.
Like a liquidity fund type solution. Very interesting. Sorry,
you have to understand, we have worked with Garantco, and the reality with some of these insurance products is twofold. Number one is a demand analysis to understand whether there's enough demand, and we're going through that phase right now. The reality is, if it isn't, then what? Could this become more of a regional project structure to try and get enough demand? Because if you don't have enough pipeline to provide the kind of guarantees that a Garantco provides, you're going to struggle with this industry. So I think that is something that is practical and workable if there is enough demand, and we're still going through that phase. And I still go back to my earlier point about the need to bring more merchandise to the market. So projects that have been finished, bring that to the market. I think it starts to create some liquidity scheme through this guarantee process. The second thing, in my opinion, is regulatory. When you put an insurance product like that backed by Garantco, what is it? Is it a bank? Is it an insurance company? Who backs it? Who regulates it? These are questions that need to be answered before we start to launch into that aspect of project development. We're going through that phase right now. I think, does it really solve a problem? I think it will solve a problem. Obviously, monoline insurance companies receive a bad rap because out of about 8 of them in the US or 9 of them in the US, after the last financial crisis, only 1 is standing. But it doesn't mean that that is not a good business to focus on. The reason many of them failed was because they were not focused on what the right products were. They all went on to derivatives, things that they didn't understand. So going back to this, I think this is something, and it's something that should be supported, not just by the ADB or by the World Bank, but across, and not just for Nigeria, but across, maybe on a regional basis, on a West African basis, to make sure that we have enough product demand. If you go to some of these other countries, some countries are just one country projects, one project countries. Can you create that in some of these countries? No. So I think a much more regional solution is very important. But back to a point that's been made earlier about financial inclusion and the impact of Basel III. This is what I think happens over time. With Basel III, you're going to see less and less participation by banks, investment banks, commercial banks, in projects like this. Principal investing is being shut down. Commodities trading is being shut down. So what happens next? What replaces that? I think here is an opportunity for an evolution of the infrastructure fund to kind of bridge this gap. Today in Nigeria, and one of the things we've done in NSIA is, given the size we started with, we decided to outsource a lot of our investments. In the equity market, we did. In the hedge funds, private equity, we did. But in infrastructure, we couldn't. Why? Because there were probably just one or two. And the reality is that the one way to start to bridge that gap is the creation of specialist financing vehicles. And I think, today, I'm surprised that, this hasn't quite taken up. I mean, we look at some sectors that we have no expertise in. For example, agriculture. We partnered with the Ministry of Agriculture to invest in a new fund to invest in agriculture. These are some of the things that are quite necessary. And when I look through this crowd, my sense is the creation of an infrastructure fund or infrastructure funds as a category is very, very important now. And this is, in my opinion, the quickest way to start to bridge this gap. It gives investors like us or investors from outside the country the diversification across asset classes, development projects that are mature. And that way you're one level removed from having to take the big risk of putting your money, because he talk about risk. Infrastructure is risk. A half-developed bridge has no value, right? So the point is, at the end of the day, you have to make sure that you should be able to get bids. So this, I think, in my opinion, is a new category of financial intermediation vehicles that at the moment will become quite necessary, and I expect that to grow over the next 5 to 10 years in Africa.
So over time, are you anticipating listed African infrastructure funds in the same way that you have listed infrastructure funds elsewhere?
Absolutely.
And that perhaps some of these 200 projects that Moody's assessed and they found a default rate that was very low, some of those could be some of the initial instruments that get put into vehicles, whether it's captive insurance or whatever innovations are out there,
sure,
that will transform the way that we invest in infrastructure and drive down the perception of risk on the continent.
I will expect that. I will expect that for many reasons. Number one is I can split my infrastructure fund into tranches. One is a tranche that's producing. So I can invest in these funds and have things that have gone past that steep J curve that you go through with infrastructure projects, and have something that helps me diversify my portfolio a little bit. So I expect to see more of that. But again, it's still evolutionary. 20 years ago, or I would say 25 years ago, there were hardly any private equity funds in Nigeria. Today, there's quite a few of them. Mm-hmm. Infrastructure, we're at a phase where we have just one or two at the moment. I expect to see more of this. And I think if there's any one positive impact I expect from Basel III is the fact that as commercial banks get less and less involved in some of these asset classes, we'll start to create these new vehicles, and we can list them. I believe in the markets. I believe the market serves a purpose that people haven't quite fully appreciated, especially in pricing of risk. And I think that this is one area that will all start to begin to benefit.
Do we need some form of incentives, like in the US, for example, where they really had to stimulate the venture capital industry by giving some tax breaks and concessions to really stimulate the growth and the emergence of that industry, or it's just private sector development?
We will need, I think it was Taz who said that everything is needed. Incentives will be very useful, but I actually think that it is still going to be led by individuals. It's going to be led by the private sector. Incentives by way of tax reductions and tax free status for some of these things have already been in place. But I think that funds and we classify most sovereign wealth funds in Africa these days as sovereign development funds because of the impact to try and develop the local market can play a role. But more importantly, I think banks like the ADB and the World Bank should play a role and look at this category as areas that need to be developed.
So it's leadership around channeling and building an ecosystem.
That is correct.
Because we've heard, for example, if we're looking for more IPOs, one of the most obvious ports of call should be the private equity industry. But we tend to find that they look at a different sort of exit route with the trade sales and not necessarily pure IPOs. So on the infrastructure side, where do you think the leadership could come from to make this happen, as you see it?
Yeah, I think the leadership will come from two aspects. Number one, you're seeing more and more sovereign wealth funds being created in Africa, and I think some of these funds have a mandate to invest domestically. I know there's all kinds of research about whether this is the right thing to do, but I don't see why, if investing in Africa is important for a Temasek, why a Nigeria infrastructure fund, a Nigeria sovereign wealth fund cannot also invest in Nigeria if you have the right governance. And I think it comes down to governance, independence of the board in choosing projects to invest in, the lack of interference from
fiduciary.
Fiduciary, exactly. So if you have the right governance, this, I think, will start to help. So funds like this that have a mandate to invest domestically is the first step, in my opinion, in solving some of these problems. The other ways where I think you start to find roles, it's more in the making sure the regulatory environment is not too difficult for funds to be registered, for funds to play a role. And I think all of this will help. Taxes obviously will help as well. But in terms of getting everyone together, the fact that African countries are willing now to save and invest in their own environment, I think is one big step that I think will help some of these funds develop.
Super. I know you have something to add here, Taz. So.
Well, I wanted to add, but I think Uche is a big advocate of Africa 50. He already described Africa 50. So, because Africa 50, as you said, right structure is very important. That's why it's going to be a corporation. It's going to have commercial structure. It's going to be autonomous from African Development Bank. It will have its own rules and procedures. And it will be totally legally and financially independent from the bank. And it will have different tiers of capital, which will attract different type of investors. I can give you one example without any name. Africa 50 is about to partner with a platform that fronts 764 pension funds from all over the world. And their interest actually for large projects, they are transformational, and they don't have very high return expectations, but they have high expectation in terms of those returns are steady and long-term. So therefore, we believe that the structure we design for Africa 50 will be attracting not only sovereign wealth funds, but also some frontiers for pension funds all over the world.
I think it just reminds me of one of the sayings. I'm not saying this is what Goldman believe wholeheartedly, but sometimes the messenger becomes more important than the message. And as you know, and as Goldman tended to say, that you don't necessarily need to raise money on the back of a business plan. You raise money on the back of relationships. And I think it's clear from everyone in this room, and the IFIs and the ADB and the World Bank, there's a lot of goodwill there that could really catalyze unprecedented levels of capital. And I think this is an example. I think the Global Infrastructure Facility is an example, and some of the innovations that we're hearing from the market. So I think on that, I'd like to hand over to Maktar and Taz as the co-chairs to make their closing remarks. And I think ladies first, as you rightfully point out.
Well, actually, just very, very few words. We all know that the need is huge. I think all of us, we have no other choice but get together and work together to address this huge infrastructure gap in the continent. That's why actually African Development Bank looked at its own business model and looked at also market's need. And that's why we decided to create a new vehicle to make sure infrastructure delivery will be much more faster in the continent by partnering not only with the governments and helping them with the capacity, but also with the private sector. It's going to be a pure partnership platform, and Africa 50 as different windows will be offering different returns to investors. For example, project development component will be offering 15% return to its investors, while project finance component over 15 years will be offering 8% return. Say that today we have almost 600 million commitment from African governments. They will be having over 15 years, 8% return on their investment in Africa 50, which is win-win. Africa 50 will be providing them financial returns, providing them actually infrastructure delivery in a much more faster way, and also their projects will be reaching the financial close and serving their people. So I think at the end of the day, Africa 50 will be partnering with African Development Bank very closely, and World Bank as well, because we looked at very closely with the World Bank Global Infrastructure Fund. Actually, there are certain things we did not cover, they are covering. I think there's a huge opportunity for partnership. So we want to see also Uche as an investor in Africa 50. So I committed him in public.
Okay.
Thank you very much. I think that the word of conclusion, I think I will go to what you said as a word of conclusion. All this is based on credibility of institutions. And credibility of institutions means good governance, at the private sector and public sector. Because that good governance is not only a story of the public sector. We have also to make sure that good governance is also totally embraced by the private sector, to make sure that institutions that we are building in the private sector and the public sector can compete with the rest of the world and bring that. Any reversal that we will have in our policies will hurt Africa much more than it will, because exactly as you said before, Africa doesn't have a long track record, enough of a long track record to build that confidence in the market and considers that a reversal is just a mistake, but it can be seen as a change of direction. So to keep the focus, keep the same track, it would be, for me, extremely important. The second element of conclusion is that while Africa has been doing very well in terms of macroeconomic policies and changing, it's not time to rest on our laurels and think that everything is over and now. We are at a time where interest rates in the world are particularly low. We have time where commodity prices are relatively high. It's a kind of a good situation overall. We'll be facing in the future more difficult time. And I think the investments that African countries have made in the past, which allows them to resist the crisis of 2008 and 2009 and continue growing at that time, it was the result of very hard work. And we need also to continue this hard work to be able to resist the next shock that we'll be facing, because those shocks will be happening. So hard work, no complacency, avoid reversal, build institution. And I think I will ask our colleague from the private sector, a part of a public service, write down your very nice idea and share it with us so we can try to capture it and make sure that next time the commitment that I will have for this panel is to come with some more concrete and practical suggestions so that we can implement them and translate them in actionable action. Thank you very much.
Superb. Thank you. Well, that brings us to the end of our panel. Please join me in giving our panelists another round of applause, please. And thank you for being such a great audience. Thank you.